Hello my friends and welcome back to ACCA Tax Practice Phase. Today we're going to have a look at a question that's got some income tax for a sole trader and some employment for their spouse. And this question is going to get us to really challenge how to calculate the tax for these individuals who are taxed on a different basis. So this is really looking at self-employed with a little bit of employment. Now, Alfred and Amaia, we're told they are married, and we can also see in the question that there are two requirements here. Now, we've got some information for Alfred to start with, and we can see that he's a sole trader. And then we've got Amaia, and we can see that she's employed. Now, before we get into the detail, let's just have a quick look at the requirements. 15 marks in a 3-hour paper should take us about 27 minutes. And we can see that 6 marks of that is for calculating Alfred's revised adjusted trading profit for the 7-month period and to work out his taxable trading income. Now, in this question, we're not asked to work out his tax liability, we're just asked to work out his trading profit. And we're asked to work this out for 24-25. Then separately, what we're going to do is we're going to have a look at the tax payable for Amaia. So this is then going to start using rates and allowances. Now, we're going to use the allowances tables when we work things out for Amaia. So I'm just going to point out where these are, so we're not darting backwards and forwards between the two. So what we're going to do is we're just going to have a quick look at these rates and allowances and remind ourselves of what's in here. You can see that when we come to working out Amaia's tax, we've got the basic rate band with the 20% and the higher rate being 40%. We've also got some different rates for dividends. And also we can see that we have information about the personal allowance, which is also going to be useful as well. So I think this is going to be on the first page of your tables. You're always going to get this in the exam. So let's just make sure that we know where this is. What we're also going to look at in a little while is looking at cars. We're going to see when it comes to employment that we're going to be looking at the car benefit. And I want us to be able to identify the car rules. We probably will come back to these when we get round to looking at Amaia because I think they might be quite useful there. So let's go back and have a look at the question itself. And we can see that we've got, try and start down here, we're going to start with Alfred. Now we did say, didn't we, going back down to the requirements, we're going to work out his adjusted tax profit for a 7-month period and his taxable trading income for 24-25. Notice as well that when we work out these tax adjusted trading profits, we're going to start with 163,000. I'll explain what that is in a moment. And it says if there's anything that you feel doesn't need adjusting, then you're going to write a 0 in there. So let's start. I probably need to put a little bit of a heading in here first of all. Let's start off with Alfred's adjusted trading profit. Now you'll notice that this is for a 7-month period. And it says that it's going to be for the 7 months to the 31st of July 2025. Now, we're going to work out what these amounts are going to be taxed on in 24-25. So that's really quite important. But we're just going to start first of all by working out these adjusted profits. And then what we'll do is we'll start working out what he's going to be assessed on in the tax year. Okay, so first of all, it says start with the 163. So let's work out where that 163 comes from. Now, here's everything we need for Alfred. We're told, first of all, if we put a pound sign in there, might be a good thing. And then we're going to start off, first of all, with his profit figure. And you can see in the question, it says that he's got a draft tax adjusted trading profit of 163 before adjusting for any of the figures below. Now, that means that we're not doing an adjusted profit comp necessarily. We're trying to see whether these items numbered 1 to 5 need adjusting for. So the first one says we've got 5,000 incurred in January. So this is when he started trading, and February 24. Oh, no, it's not. It's the year before, isn't it? A year before, on a marketing campaign for his business. Now, we call this pre-trading expenditure, and you're allowed to deduct it on the first day of trading if you can prove that it's something that would be adjusted had you started trading. And I think anything to do with marketing would be allowable. So I think that figure is absolutely fine. Then we're told we've got 4,500 of sales recorded in the accounts were made on credit and payment wasn't received until August 25. Now we know that by default, any cash basis is going to be used for working out adjusted profits for sole traders. So therefore, we need to make an adjustment for that credit sale. Now, if those sales have been included in that overall profit figure, this needs to be deducted if we're working out the cash basis. Then we're told that we've got the cost of a golf day. Now, a golf day here is for clients. This is what I would call client entertaining. And if he had deducted this from his profit figure, I would have been adding this back on. But because he's not adjusted for this client entertaining is going to be ignored, and there is going to be no adjustment or deduction for it. Now, the next one that we've got down here is talking about plant and equipment. This is going to be the cash basis. So there's not going to be any capital allowances on the plant and equipment. Instead, what we're going to do is to deduct the whole expense as an allowable trading expense from these numbers. So the 116,000 is going to come away. We're then told that he bought a car in February 25 for 24,000. It's got CO2 emissions at a rate of 44 grams per kilometre and is used by Alfred's employee. Alfred chooses to claim the capital allowances. Now, the capital allowances on this car are going to be given based on the carbon dioxide emissions. Now, we know that if the carbon dioxide emissions are low, if they're below 50, we're going to include them in the main pool. And what that means is that these capital allowances are going to be based on an 18% writing down allowance, but only for 7 months. It's not how long we've had the item, it's the length of the accounting period that determines how much we curtail this writing down allowance for the short period. So I'm going to pop in here 18%. Now remember, the examiner can see your workings. So I'm going to multiply that by the 24,000, which is the amount of the car, and I'm then going to multiply it by 7 over 12. Now I should have put a negative in there, really, shouldn't I? Because this is, I'll put it in front of there, it doesn't really matter. This is an expense, so I want this to be deducted from my profits. Now I'm just going to chip over the page to make sure we've not missed anything. We haven't. Now I think we've covered all of Alfred's expenditure. So I'm now going to work out what his trading profit is. So we're going to call this trading profit, always after capital allowances, and we're just going to add this up. And we can see that that comes to 34,980. But we're not finished there, because what the question said was, tell me what the trading profit would be for the tax year 2024-25. And I'm just going to put that down here. So you can see we want the trading profit for 2024-25. Now, This is going to be from the day that we start trading up to the following 5th of April. Now, if I've got a 7-month accounting period to July, that means that I'm going to take August, no, I'm not. I'm going to take, where did we start trading if we work backwards? We started trading on the 1st of January, didn't we? So January, February, March. So I'm going to take this to the nearest whole month. So I want 3 of the 7 months profit. So it's going to be 3 divided by 7 multiplied by my adjusted profit figure here. And that is going to be the taxable income, or taxable profit for 2024-25. And I'm just going to round that down a little bit. I think we're just going to make that a little bit smaller. There we go. So it's going to be about £14,991. Not bad for 6 marks, really. Now, the second part of the question wanted us to work out the tax payable by Amaia. Now here, if I'm working out tax payable, I need to work out the taxable income, apply the tax rates, and then I'm going to deduct from that any tax that Amaia might already have paid. How do I spell Amaia? Is that right? Amaia, yeah. So we're looking at income tax computation for 2024-25. Now, when I look at her income, I've got quite a lot down here, but you can see that I've got a salary, and then it says that we've got a petrol car and we've got some living accommodation. So all of that is going to be non-savings. And then we've got this PAYE, and then we're told about some furnished rent. Well, that's still non-savings income, and we've got some expenses on that too. Now, what this means is that when I'm going to be looking at her tax computation, and I'm going to put a little pound sign in here, there we go, all of this is non-savings, which is great because it means I've only got one tax rate to remember. So let's work out what we're going to do. Let's go down the question first of all. So I'm just going to move this up a little teeny tiny bit. There we go. Completely overshot. There we go, Amaia. So let's start off down here. Now we can see over here that we've got a gross annual salary of 80,000. I'm not told in the question that she's been employed for part of the year. So I'm going to assume that that salary is going to be her entitlement for the full year, and she's been working for the full year, is 80. That's the first thing. Then we're told that she's got a petrol company car. The car had a list price of 25,000 and we got a discount and only paid 23,500. That is not relevant. It's always the list price that we use for the car. And we're told that she's got carbon dioxide emissions of 52 and they didn't provide any fuel. Now, when we look at the car, what we have to do, you'll remember, is to try and identify, first of all, the relevant percentage. Now we've got, what's the cost? We've got 25,000 is a cost. We're going to multiply it by the relevant percentage, and we're going to multiply that by how many months she's had the car. Now you'll notice that she's only had the car from the 1st of January 25. So for the year ended March 25, we've had it for 3 months. So which means that when we come to do her tax comp, we're only going to be looking at 3/12 of the car allowance. Now, let's try and find out what this percentage is. So I'm going to go back to the car allowance tables, and you can see here that where we've got a car where the carbon dioxide emissions are between 51 and 54, we're looking at a 15%, can't read it, a 15% standard allowance. Now, I think that that is the right figure here, isn't it, for Amaia? Because when we go back, we can see that she had 52 grams There. So I think this relevant percentage that we're looking at here is going to be 15. So let's just work out what this is going to be. We're adding it. So we've got 25,000 times by 3/12 times by 15%. And we've got a figure there of about 937.5, 938. We'll do it the nearest pound. There we go, it's your car. Then we're told that she's got some living accommodation. Now the living accommodation, it says it qualifies as job related. We have an annual value and we're told that the employer pays rent. Now, if it wasn't job related, we would be looking at the higher of the annual value and the rent payable by the employer. But this is job related accommodation, and the provision of the property itself has no taxable benefit. Oops, not even typing in, is it here? So job, there we go, job related accommodation. And I'm just going to put in here a 0, as the examiner asked me to do, when there's no benefit. Then we're told that we've got some deduction for PAYE. Well, we're going to come back to that a little bit later. I think that's going to be useful for us, but not just yet. And then we're told that she's also lets out her own unfurnished property at a rent of $1,200 a month. Now, when you let out your property, that property is going to be taxable on a cash basis. We're told that she received 13 months of rent during the year, and she's got a mortgage and made some mortgage payments which incurred some interest of $2,600. She also paid an insurance premium on the 1st of December 23. Well, this is a cash basis. I'm looking at the payment made in December 2024, regardless of the period that relates to. Now, we have to remember that with property, we are going to be looking at the cash basis of income, and we're going to be looking at the expenses that have been incurred. So in here, I've put a little working underneath. Whoops, going the wrong way. So working for property. So we've got income. Remember, cash basis. So the 13 months worth would be included. We've got $1,200 a month for 13 months. That's going to give us $15,600. We've got some insurance, which we said was on a cash basis. So that's going to be, what did we say that was? $1,250. Even highlighted it. There we go. And then what I've got to think about is this interest. Now, the interest is not given relief here. If you remember, interest on residential property, the mortgage interest, can be taken as a tax reducer. And I'm going to show you how to deal with that very soon. So let me just work out this total figure here. So we've got total net income of, what have we got here? 14,350. And I'm just going to put in here the property of 14,350. If you wanted to, you could have just put the workings in a cell, but I think sometimes it's easier just to set them out in case you make a mistake. Now, I'm going to add up my total income. This is not taxable yet because I have not deducted the personal allowance. But if I add up the total income, I've got a figure there of 95,288. I'm then going to take off the personal allowance. Doesn't need to be restricted because the income is not greater than 100,000. And we then have a taxable income figure of the net. So we're looking at 95,288. Oops. Fat fingers. There we go. 95,288 minus the personal allowance leaves us with 82,711. Now, do a quick check, make sure that there's nothing we need to amend the basic rate bands by. And I don't think they've mentioned any charitable donations, and we've not also had mention any personal pension contributions. So the basic rate band is going to be the usual figure of 37,700. If you can't remember, go back to your rates and allowances. So we've got 37700, and that's going to be taxed at 20%. And then we've got the remainder, which is going to be taxed at the higher rate band. So this is going to be your figure of 82,718 minus your basic rate band is going to be taxed at 40%. Now we're just going to work those out. So over here, equals, I'll do 37,700 times by 20%. And then I'm going to click and drag to the next figure. That's then going to give me my tax liability, I hope. But what I can also do is at this stage, I'm going to look at the interest relief on the mortgage of the property. Now we're allowed here the amount of interest we paid. Now over here you can see that we've paid interest on that of 2,600. Can you see that? So in here we've got 2,600 and the tax reducer is always at 20%. So I'm going to take the minus 2,600 and I'm going to give myself tax relief of 20% on that. So I'm going to reduce my liability by 520. Now, importantly, your income tax liability is after that relief. So your figure here equals sum is going to be these numbers added up, and that's going to be your income tax liability. From that, we need to take off any tax that's already been paid. Now, if you look in the question, it tells you the big bit up here that I put a great big circle around that we hadn't dealt with is looking at the PAYE of 19,432, so 19,432, which is then going to leave us with a tax payable of the net figures. So in here, you're going to take those two and you're going to get a tax payable of 5,595. Now, it's quite a lot to do in that question, I have to say, but it's a really good one because what we reminded ourselves of up here is how to adjust profits. It's an unusual one, this one though. We're not starting with a net profit figure and adjusting like we would do with accruals. This is cash basis. And under the cash basis, we're going to deduct any amounts that we haven't deducted so far that we do get relief on. And that would include the plant and machinery and any capital allowances on cars. Notice the 7-month period gave us a restriction on those capital allowances. We weren't asked to work out the tax, but we were asked to come up with the year that it's going to be taxed in. And for 24-25, we always go from the day we start trading up to the following 5th of April. So for the first year of trading, his income is going to be 14,991. For Amaia, she is employed, so we have got salaries and company cars. But importantly in this one, it did give us a glimpse of a job-related accommodation. Also notice that when you're dealing with property income, it's on a cash basis for an individual and any interest relief on the mortgage is not deducted from the property income itself. It's treated as a tax reducer. Well, my friends, I'm going to leave you to have another look through that one. Enjoy, and I look forward to seeing you next time. Bye for now.